Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So as you're watching this, I am probably on holiday enjoying some sun, but as I do that and I kind of relax for a few weeks, I want to continue to bring you some content on this YouTube channel. So in order to help me do that, I have enlisted the assistance of a guest, and that guest for today's video is Andrew Brown. Now, Andrew is a fellow finance YouTuber and value investor with a super interesting background. He's originally from Australia, ended up starting his own business and then having quite a successful exit from that business, and he's now basically a full-time value investor. Now in this video, Andrew is going to run us through the importance of having an investment checklist in order to avoid investment mistakes over the long term. So I hope you do enjoy it. Definitely go over and check out Andrew's channel if you haven't seen it before. And big thank you to Andrew for putting this video together for me so that I can continue to relax and we still get the viewers some great content. So I appreciate that very much, but for now, let's get straight into the video.
Hi, my name is Andrew Brown from my own channel called Andrew Brown. Not very original, I know. Anyway, Tom asked me to share this checklist with you today. As you know, Tom is a big Mohnish Pabrai fanboy, and so am I. And one thing that Mohnish Pabrai keeps secret from everyone is his checklist of items he goes through when evaluating a company. Now, Mohnish Pabrai isn't the only one who likes a checklist. A lot of famous investors have this idea in common. Phil Town, Guy Spear, and Peter Lynch are the ones that come to mind. I studied these guys and created my own checklist that I think would look similar to theirs. And that's why I'm here today, to give you my checklist that I have so far. So my list is about 55 items long, whereas Mohnish apparently has a checklist of 160 items and counting. So consider this a good starting point to add more and more as you think of important things. So what I'm trying to do with all of these items on this checklist is answer them and look for red flags, reasons to not invest. So let's get into it, and the first section is called industry. Okay, so the first item on my checklist is, do I think I can easily understand this business? Now, it's maybe not now, but it shouldn't be too hard to understand. I've analyzed the pharmaceutical sector before, and that is really difficult, whereas, say, clothing is something really simple to understand. Some things will be easy to understand, and some things will be super complicated. So my sister's husband is a doctor and he knows the pharmaceutical world really well. I think I could understand any industry given enough time, but some are just easier than others and I just don't have all the time in the world. What gurus are investing in this company? Now, I just do a 13F search and see which famous investors have invested in this company before. It is a good sign if one or more super investors have invested in the same company. Do I actually like the industry? See, I don't like the cigarette industry. I hate cigarettes. I don't like cars, so I avoid the car industry as well. It's just a personal preference. Is it in a no-growth industry? So electricity and utility providers are a good example here. No-growth industries actually attract less attention, and it can be a good thing. But we still want growth. Maybe the company is doing something new in a no-growth industry. Is it in a boring industry? Well, funeral services are pretty unsexy. But this is a good thing, as there is just far less hype in these areas. Insurance is unsexy as well. What type of investment is it? Is it a fast grower, a slow grower, a stalwart, an asset play, a turnaround, a cyclical? This will just make sure that I know the company quite well. So a fast grower is something growing at about 25% per annum. A slow grower has single-digit growth. A stalwart is something that's like 10 to 20% growth for long periods of time. Asset plays is a company where the company has a lot of assets and the stock price is just far less than the total asset value. My example of an asset play would be the oil tanker market, which I have researched extensively. Now, a cyclical is a business that has patterns of good profit times and bad times. Again, the oil tankers are cyclical as well. Then we have turnarounds, a company that has been punished and is trying to reorganize and grow again. Think like Nokia or Xerox. They're old technology, but maybe they have something new that is going to change everything for them. Now, whichever area the company falls into, it doesn't really matter. It is just a test to make sure I know the business. Does the company have reasonably simple plans for growth in the future? My example here is Sprouts Farmers Markets. They have said that they plan to open 30 new stores a year in different areas across America. That is a pretty simple plan for growth. Is the market cap bigger than $10 billion? Now, bigger is okay, but the smaller the company, the bigger the upside potential. Look, I've invested in Facebook, Berkshire, and Google. Look, great companies and I got good prices, but they aren't going to go up 100x over the next 30 years. A smaller company can go up 100x as the market can handle that growth size. I don't think Facebook is going to be a $100 trillion company in the future. And following on from that point, the next question is how big could the market or business potentially be? Is it going to go worldwide, countrywide, or do they only have like a very niche client base? It is reasonable to expect Sprouts farmers markets to spread across every country in the world like Facebook. Well, I don't think so. Okay, now we move on to the next section, which is called the competitive advantage. Now, Warren Buffett calls it the moat. Okay, now the first type of competitive advantage we're looking for is whether they have a brand, and is the brand really important to their sales? Look, Apple is a good example. I live in Ukraine, and even though the average wage is like $500 a month, everyone has an iPhone. It is a status symbol, and that is just the power of a brand. Next is switching costs. So is it hard for the customer to switch, or maybe it's painful? So if you've been using, say, Dropbox for a while and your work uses Dropbox, well, I can't imagine you moving over to Google Drive. It's a pain to move everything and learn the new process. Next is a toll bridge or a monopoly or a near monopoly. Now, my example here is a company called Global Cord Blood Corporation, and it's in China. Now, they're actually based in 3 of the 7 provinces in China, and the rules of the government say that in each province they can only have 1 umbilical cord storage company. So in 3 of the 7 provinces in China, they're a monopoly. Maybe the company has a secret like a patent or a formula or a recipe. So for example, Qualcomm, they have lots of licenses and other companies have to pay them. And KFC, for example, has a recipe. The next competitive advantage that the company might have is price. Are they a low-cost provider? See, Costco, well, they can sustain low costs for a long period of time. Whereas someone like Virgin Airlines, when they came into the Australian market and put their prices crazy low, well, that was unsustainable. Now, this isn't a great competitive advantage, but maybe the company is just in a really good niche. For example, Markel is a company that is very good at specialty insurance. Things like moving art pieces between museums or international horse travel. They have a niche in the insurance world. Next we look at, is this moat or competitive advantage durable? Will it get wrecked by something in the future? So of course we just can't predict the future, but something like autonomous cars are going to wreck the taxi industry, stuff like that. Okay, the next item on my checklist is it super hard or expensive for someone to start competing? Now, Micron is my example here. So Micron factories have specialized machinery and it is very, very unique, and it would be super expensive for a new competitor to come along and spend billions of dollars to set up the infrastructure. Next question I ask myself is, will a cheap country come in and undercut them on price because they can just pay cheap labor? Pretty much any manufacturing company has this issue. The next point I have is, who are the competitors and do they compete directly without a point of difference? So I'm just listing the competitors here. Do customers have to keep buying from them? Well, Netflix is a really good example here because recurring payments are awesome. All right, so the next few points now are some actual just like hard numbers that we look for in the financial statements. We want to see net income having historical growth over 10% per year. Now, we don't look at earnings per share because share buybacks can artificially create earnings per share growth. So we want to see net income growth. Then we also want to go look at the book value historical growth over the last 10 years. We also want to go then look at the sales historical growth over the past 10 years. We go look at the operating cash historical growth over the past 10 years. Then we see how good are their gross margins. So 50% or higher is a great sign. Look, bigger is better here. Large gross margins gives the company more flexibility and will most likely have more options for growth. Now with these gross margins, we want to see they are improving or maybe they're declining. This is a sign of a business moat. If a company can grow their gross margins and sales and the other growth metrics are growing as well, it means that this company has a competitive advantage because they can increase the prices and still grow sales at the same time. Now, based on these growth rates, get a feel for an estimated growth rate for the next 5 years. Now, I check analysts as well from Yahoo and Zacks, and I'm just wanting to know whether it's speeding up or slowing down. Look, to be honest, this is actually a bit of a guess. Look, I try to look at those past growth rates and estimates for the future and make some sort of decision myself. I try to be on the conservative side as well. Say Amazon is projected to grow at 30% per year for the next 5 years by some analysts, and look, I prefer to use 20%. And while we're looking at the company's history, we want to see how they performed over the last recession. Did they nearly go bankrupt, or did they just dip a little and power on out of it? All right, now let's move on to the are they well managed section. Return on tangible equity. We want to see this above 15% and hopefully growing. Look at how they performed over 15 years, as I want to see how the performance went in the GFC. So tangible equity actually takes out the goodwill to get a better indication of overall return on equity. Now, this is just a metric that shows us whether the business is compounding. Return on invested capital, or ROIC. We want this above 15% and consistent over 5 years. Look at how they performed over 15 years as well because of the GFC. Look, this is the ability of the business to turn their profit into more profit. Look, this is probably the key ingredient in compounding, and I probably think this is the most important metric. Does it pay a dividend? Now, I actually don't like dividends. Dividends is money leaving the company and can't compound anymore unless I find something else to invest in. Dividends should be the last option from the management team and it shouldn't be the priority. So look at the dividend policy of the company. The next thing I look at is the debt to equity ratio, and I want this under a 0.7. The number one reason businesses get into trouble is debt. This is a good indicator of manageable debt. Then I look at the current ratio and I want that over a 1.5. This is another debt metric. This is short-term debt, and we definitely want this to be okay. Then we're going to go take a look at the cash in the bank. So can the debt be paid off quickly if needed? So we look at the cash they have and the total debt and hope that the cash can nearly cover all of that debt. Now, while we're looking at cash in the bank, we want to see it growing. So if it is, this is good news, as the balance sheet is getting stronger and the management team have more options. Maybe they expand, maybe they buy out a competitor. When has too much cash ever been a problem? Then we see if the current assets are strong enough to get through their tough times. So we go see if the current assets are bigger than the average expenses on the income statement. Another thing I look for is how big is the goodwill in relation to the assets that they have. I want to see it less than 1/5. Goodwill is what the accounting department have decided the brands owned by the business are actually worth. It is very subjective. I prefer to ignore goodwill. Some companies have really large goodwill numbers, and this looks like they have a lot of assets, so it can be a little misleading. Now we go look at the free cash flow. So this is the number we want growing, as it is the thing we want to see compounding. Free cash flow is the money the business has left over after using all of the profit for investing back into the business. Free cash flow is the money left over for the owners. So we really want to see that strong. All right, so the next few questions, they're actually really subjective, but I still think they're very important. So the next one is, how honest does the CEO sound in the last 3 years of annual reports? This is just a gut feel you need to get. How salesy does the CEO sound in interviews? Again, this is just a gut feel. Does the CEO sound defensive in difficult times? Again, this is a gut feel. And I read the CEO's background. I try to work out how smart they actually are. So, for example, Warren Buffett, well, he comes across as a really smart guy. So does Elon Musk. But Jack Ma, the old Alibaba CEO, well, he didn't come across very smart at all. Yet, he is the richest man in China, and Alibaba is a beast. So there are obvious exceptions to this. Look, this is all not that important. This is just to make sure we have done enough research into the company. So while we're investigating the CEO, we also want to see how invested they are in the company. Are their shares more than their salary? So we want the owners, like the CEO and stuff, to have the same incentives as us as shareholders. So if the CEO's net worth is tied to the stock price, well, that is the same as us. They will be incentivized to make decisions in the best interest of the shareholders and themselves. Now, I also write down if there are any rumors or current issues with the company, and maybe these are just temporary things. Sometimes this happens. It can create buying opportunities for long-term investors. Now, I also look if insiders are buying. Now, there is only one reason insiders of a company are buying. That is because they think it is a good investment. Simple as that. Is the company buying back shares? Now, this can be good and bad. Now, Tom actually explained this in his video called Buffett's 3 Reasons for All Bad Investments. So go watch that for an explanation on this point. Okay, now the last section of my checklist is called price. And in that same video that I just mentioned, Tom explains why buying at a bad price can ruin your investment. Actually, I have a video also about why the wrong buy price can ruin your investment too. So we all agree price is a very important part of investing. So here are my 4 methods. And the reason I have 4 is they will give different answers. I then get a range of buy prices. I can then use my own discretion to find the price that I want. Look, we're just trying to get some sort of ballpark figure here, nothing exact. Look, getting an exact price isn't possible. The first way to find a good value is called the 10 cap method. And this is a very conservative approach. And it's also sometimes called the price to owner's earnings. And this is actually courtesy of Phil Town. Okay, to work out the 10 cap method, we get market cap and we divide it by the owner's earnings. Now, owner's earnings is made up of operating cash minus maintenance capex. And we multiply all that by 100 to give us a percentage. So if this answer is 10% or greater, it's a good deal. Simple as that. Oh, and just a little hint here, if you can't find that maintenance CapEx number, well, instead of using this formula for owner's earnings, just use free cash flow instead of owner's earnings. The next method I use is the price to free cash flow method. Now, this is just a very rough guide, just to give me a very quick indication. So, if the company is growing at around about 5% growth, well, a good buy price would be when the price to free cash flow is under 4. Now, if the company is growing at around about 10%, well, a good buy price would be the price to free cash flow under 8. And if the company is growing at 20%, well, a good buy price would be the price to free cash flow number under a 16. The third method I use is the discounted cash flow. Now, Tom has a video on discounted cash flow, so go check those out. So the fourth method I like to use is what's called the price to tangible book value. So what I get is the current price to tangible book value, let's say it's 0.7, and the historical price to tangible book value, let's say it was a 1. So if the current price, that 0.7, is 30% or more below that historical average, well, then it's a good price. All right, here is the total checklist. Look, please take it. It's yours, you can use it. Look, I think it's really helpful. I'm going to be using this checklist in a real life step-by-step example over on my channel using the company Markle at some stage in January. And Tom, mate, you're an absolute legend. I watch every single one of your videos and it's been a real honor.